Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Coherent.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us get this information out to more people like you.
So today I want to start with a mental image. I think it perfectly captures what's going on in the market right now. Picture a brand new cherry red Ferrari engine.
Okay.
I mean, massive horsepower, incredible engineering, just raw power. But now, imagine you try to connect that engine to the wheels using a rusty bicycle chain.
Yeah, that's a disaster waiting to happen. The chain snaps immediately and you just go nowhere.
Exactly. And that is the situation with artificial intelligence right now. Everyone is obsessed with the Ferrari engine.
That's the GPUs, right? The NVIDIA chips, the big brains doing all the work.
The big brains, exactly.
Yeah.
But almost nobody is paying attention to the chain. And that is where Coherent comes in. They are arguably the most important company you haven't heard of because they are the plumbing of the AI revolution.
The plumbing. Okay, that sounds incredibly unsexy, but, usually in the history of wealth building, unsexy is where the steady money is hiding. We're talking about optics, correct?
Correct. We're talking about transceivers, optical hardware.
Yeah.
Coherent makes the physical tech that allows these massive AI supercomputers to actually talk to themselves. Without their technology, an NVIDIA cluster is just a bunch of expensive isolated islands. It's a supercomputer that can't think because its parts can't communicate.
Okay, I really want to get deep into the how of that, the technology, because I think that's where the edge is for an investor. But first, we have to address the elephant in the room.
Go on.
I'm looking at the chart right now. This stock is up over 100% in just 6 months.
It is basically a vertical line on the chart, yeah.
It really is. And as a skeptic, which, is my job here, my alarm bells are ringing off the hook. When I see a triple-digit move like that, I immediately think FOMO, hype cycle, inevitable crash.
Of course.
Is the train already leaving the station? Are we just chasing ghosts at this point?
That is the multi-billion-dollar question. And look, when you see a parabolic chart like that, worrying about buying the top is the healthy, rational response. It is. But, and this is a big but, we don't think this is a flash in the pan. This isn't a meme stock run on hopes and dreams and, Reddit threads.
Because the revenue is actually there to back it up? Is that the idea?
It's not just the revenue. It's because of something called vertical integration. It's a term that gets thrown around a lot. But for Coherence, it is a literal physical moat. They aren't just assembling parts.
Okay.
They are growing the crystals. They control the actual physics of the infrastructure.
Yeah.
This is a multi-year play on the physical limitations of electricity itself.
You mentioned crystals, which sounds like we're veering into sci-fi or magic, but I want to pin you down on the hard numbers first before we get into the wizardry.
Fair enough.
You said this isn't a meme stock. Does the business reality actually support this kind of valuation?
The numbers are heavy. We're looking at a company that's definitely not a startup. For the trailing 12 months, Coherent pulled in $6.04 billion in revenue.
$6 billion. Okay, so this is a large cap industrial player. This isn't some speculative play in a garage.
Massive. And they're showing 20.8% year-over-year growth.
See, that's the anomaly, though. Usually when you get to $6 billion in revenue, you're growing at, maybe 3 or 4%? You're like a utility at that point. 20% growth at that scale is aggressive.
It's very aggressive.
What is the engine driving that? Is it purely the AI hype?
A huge chunk is AI data center optics. It's the demand for what we call 800G and 1.6T transceivers.
Okay, stop there. 800G and 1.6T. I see these numbers in analyst reports all the time, but for the listener who isn't a network engineer, what does that actually mean? Why does that number matter to their portfolio?
Think of it as the width of a pipe. In the old days, and by old days I mean like 3 years ago, we used copper cables or much slower optics. But AI models, like the ones powering the chatbots we all use, they don't live on one chip. They're too big.
Right. They're shattered across thousands of chips, so the chips have to constantly swap data to think.
Instantly. And they need to move massive amounts of data. So 800G is 800 gigabits per second. That's sort of the current speed limit for high-end AI. But the models are getting exponentially bigger, so the industry is already screaming for 1.6T.
Double the speed.
Essentially double the speed.
So Coherent is basically upgrading the highway from 2 lanes to 10 lanes.
Precisely. And the physics are on their side, because at these speeds, copper cables physically cannot handle the signal. The electricity, it meets too much resistance, turns into heat, and the signal just dies. You have to use light, you have to use optics.
And Coherent is the king of manufacturing those optical highways.
That's the thesis, yes.
So the demand isn't just a trend, it's forced by the laws of physics. That's a pretty good tailwind to have. What's the forward outlook look like? Is this a one-time upgrade cycle?
The forecast is robust. For fiscal year 2026, they're projecting revenue to hit $6.7 billion. That's another 15.2% growth on top of the massive year they just had.
That's steady. Very steady.
But here's the nugget that really matters for the stock price. The EPS, or earnings per share. That is forecasted to jump over 42% to $5.02.
Wait, hang on. Revenue is up 15%, but earnings are projected to be up 42%.
Yes.
That implies massive operating leverage. I mean, they're getting way more efficient at making this stuff, squeezing more profit out of every single sale.
Exactly. And that brings us right back to the crystals, the moat.
Right. Explain this. Why does growing their own crystals make them so much more profitable?
So, in the world of optics, silicon, the stuff that standard computer chips are made of, is actually not great at handling light. It's great for logic, but it's bad for lasers. So you need exotic materials. Specifically, indium phosphide, NNP.
Indium phosphide, got it.
It's a compound semiconductor material. It's absolutely critical for generating and detecting the light in these high-speed cables. Now, growing these NNP crystals is incredibly difficult. It's toxic, it's brittle.
So not a garage operation.
No, not at all.
Yeah.
It requires insane precision. Most competitors buy the raw indium phosphide wafers from a supplier. They cut them up and build the device.
So they're just bakers buying flour from the store.
Right. Coherent owns the wheat field. They control the supply of indium phosphide right from the raw material, and they're doubling their production capacity in 2026.
I see. So if there's a supply chain snarl, which happens constantly in the semi-world, the competitors who just bake the bread are stuck. They've got no flour, they can't ship.
But Coherent's fine.
Yeah.
They're the farm.
And they capture the margin that usually goes to that supplier. That explains the 42% EPS jump.
It's a huge part of it. And because they own the whole stack, they can tweak the crystal growth to perfectly match the device design. That improves their yield, the number of good chips per wafer, which drives that massive earnings expansion.
Okay, that makes sense.
And they aren't stopping at just the cables. They have another ace up their sleeve called the OCS, the optical circuit switch.
A new product line.
It is. And it expands their addressable market by over $2 billion. Think of an OCS as a robotic switchboard operator for light.
Okay.
Instead of converting light to electricity to switch it to a different cable, which takes time and energy, it uses tiny mirrors to physically bounce the light beam to a new destination.
So it stays as light the whole time. No conversion.
Pure light. No conversion delay. No heat generated from that conversion. It is the holy grail for massive data centers that need to reconfigure themselves on the fly.
The growth story is incredibly compelling. But I have to play financial CSI for a minute. A company can grow itself into bankruptcy if it runs out of cash. I'm looking at the balance sheet.
It's surprisingly clean. They have $875 million in cash reserves.
Almost $1 billion in cash. And the current debt.
Only $48 million.
Wow. Okay, that is a massive buffer.
It creates a current ratio of 2.33.
For the listener, the current ratio is basically, can I pay my bills for the next 12 months? Anything over 1 is safe. Over 2 is like a fortress.
And that is well above the industry average. It means they have the liquidity, the cash on hand, to fund that doubling of indium phosphide capacity without going to the bank and begging for a loan at high interest rates.
They're self-funding their own empire. That's reassuring. However, I have to point out the one thing on this sheet that looks a little thin, net profit margins. They're currently sitting at, what, 1.96%? That is razor thin. For every $100 they sell, they keep less than $2.
It looks ugly on the surface, you're right. But you have to view that in the context of the investment cycle they're in. This is the turnaround aspect of the story.
So they're spending all the money now to build the factories for tomorrow.
Exactly. They are front-loading the CapEx, the capital expenditure. As they scale up production and, crucially, as they fill those orders for the 1.6T transceivers, which command a higher price, those margins are expected to expand significantly.
So you're paying for the factory construction today to own the money printer tomorrow.
That's the bull case.
Okay, so low margin is temporary friction. Let's pivot to the technicals. The stock price itself. We mentioned it's up over 100%. It has absolutely crushed the S&P 500.
It's a breakout, plain and simple. The stock is pushing toward its 52-week highs, right around $216.
When a stock goes vertical like that, my instinct is always to wait for the pullback, a reality check.
We actually just saw a little one. There was a small slide recently at about 2.9%. But looking at the charts, analysts aren't viewing this as a reversal. They're calling it a bullish flag.
A bull flag. Okay, walk us through the psychology of that pattern for a second.
So the stock shoots up.
Mm-hmm.
That's the flag pull. Then it drifts down slightly or moves sideways. That's the flag. What that tells you is that despite the massive gains, people aren't rushing for the exits. The early buyers are holding, and new buyers are stepping in to support the price. It suggests there's psychological support. Investors are just waiting for the next catalyst to buy more.
And what about the volume? Is this just retail traders chasing hype, or is the smart money involved here?
The flow indicates sustained upside. We're seeing clear institutional accumulation. That means the big pension funds, the hedge fund, the whales are buying and holding.
Okay.
We aren't seeing major gap downs or panic selling. They seem to believe this is a long-term winner.
That does make me feel a bit better. If the big dogs are eating, there's usually plenty of food. What's the street saying specifically? Are analysts leading the price or chasing it?
Sentiment is overwhelmingly positive. Stifel, a major analyst firm, recently raised their price target to $220. Raymond James also hiked their targets.
And I saw Jim Cramer mention this one too.
He did, called it excellent technology, and explicitly said to buy the dips.
Well, love him or hate him, the Cramer bump provides liquidity.
It does. But looking at the broader consensus, most analysts rate this a strong buy. The price targets range from around $171 on the low end all the way up to $250.
So even at this elevated price, the high-end estimates think there's still another $20 or $30 of room to run.
Precisely. And looking at some of the alternative data news sentiment scoring, the recent headlines are all scoring bullish.
What kind of news? Is it just earnings fluff or actual product stuff?
It's deep product innovation. There was huge positive coverage on their quantum-safe entropy demos.
Okay, quantum-safe entropy. That sounds like the final boss in a video game. We're getting deep in the weeds. But why does an investor care about entropy?
It's all about security. As computers get faster, specifically quantum computers, they'll be able to crack all of our current passwords and encryption.
Right.
Coherent is building the tech that uses physical randomness entropy to create uncrackable keys. It's future-proofing the data center.
So they're selling the shield for the next war.
Exactly. And speaking of heat and war, they also have new thermal management tech. Bondable diamond solutions.
Diamond solutions, like actual diamonds.
Lab-grown, but yes. Diamonds are incredibly good at conducting heat. Better than copper, better than almost anything else.
I assume they aren't using diamonds just to make the chips look pretty?
No, it's not jewelry. See, the biggest problem with AI chips right now isn't speed, it's heat. If a chip gets too hot, it throttles, it slows down to prevent melting. Coherent's new tech uses these diamond layers to suck the heat away from the chip instantly. They claim it boosts efficiency by 99% compared to traditional materials.
That is wild. Using diamonds to cool down AI supercomputers so they don't melt.
It shows the new cycle isn't just about financials. It's about real product engineering that keeps them relevant in 2026, 2027, and beyond.
Okay, I'm getting swept up in the hype here. The diamonds, the crystals, light speed switches. I need to put my bear hat back on. Let's look at the risks.
We should.
We mentioned the stock is expensive. What's the valuation looking like?
It's steep. The forward PE price to earnings is roughly 32.42. The industry average is closer to 25.
So it is trading at a premium. You're paying $32 for every dollar of future earnings. Is it priced for perfection?
It is certainly expensive. The bear case is that if they miss their growth targets even by a little bit, the stock could tumble because that premium just evaporates.
And the market hates a growth stock that stops growing.
Exactly. Yeah. But there is a genuine operational risk here that we haven't touched on. It's the silicon carbide or SiC segment.
Wait, I thought we said silicon was bad for optics.
It is.
Yeah.
This is a totally different part of their business. Silicon carbide is used for power electronics handling high voltage. It's mostly used in electric vehicles.
Ah, I see. So they have exposure to the EV market.
Significant exposure. And revenue in that segment was actually down 6%.
And we all know the EV market has been, let's call it challenging lately.
Soft demand, price wars in China. It's a bit of a mess. And that is acting as a drag on Coherent's overall numbers.
So the AI boom is pulling the sled forward, but the EV anchor is dragging behind it.
That's a great way to visualize it. Right now, the AI optics boom is so strong that it's more than offsetting the EV slump.
Mm-hmm.
But the risk remains. If AI spending cools down
Yeah.
and the EV market doesn't pick up, they get hit from both sides.
The double whammy nightmare scenario. And we also have earnings coming up. That's always a coin toss.
Yep. Pre-earnings volatility is very real. High expectations mean the market will be looking really closely at the networking orders metric. If that number comes in light, we could see a sharp drop.
Okay, so let's bring this to a verdict. We've got a high-flying stock, massive AI tailwinds, cool diamond cooling tech, but a price evaluation and an EV problem. What are the key dates we need to watch?
The immediate trigger is Q2 fiscal 2026 earnings. That's happening on February 4th.
February 4th, mark your calendars. What specifically are we listening for on that call?
You want to listen for the phrase AI cash conversion. Are they turning those massive orders into actual cash in the bank? And also, any updates on that OCS platform backlog? We want to see that backlog growing.
Not shrinking.
Definitely not shrinking. And maybe keep an eye out for presentations from Photonics West 2026. They're expected to showcase more of that quantum tech. That could be a secondary catalyst.
So what's the final score? Give me the bullish score out of 10.
I'm giving this an 8.5 out of 10.
8.5. That is high confidence.
It is. Look, Coherent is the ultimate picks and shovels play for the AI era. You just can't build these massive data centers without the optics they provide. With projected revenue hitting $6.7 billion and that huge moat in photonics, it's a strong multi-year hold.
So what's the strategy for the listener? Buy now or wait for a dip?
The strategy here is to treat the pre-earnings volatility, like that little 2% dip we saw, as an entry point. The target horizon is a swing trade into the February 4th earnings to capture that run-up.
Okay.
But then, frankly, I'd be looking to convert a portion of that into a long-term hold for the broader AI expansion cycle.
So don't get shaken out by the noise before February 4th. Use the dips, but be aware of that EV drag on the business.
Exactly. The fundamentals are just too strong to ignore.
All right. That's the lowdown on Coherent, a company using diamonds and crystals to let computers talk to each other at light speed. If this helped you see the market clearly, hit subscribe and let us know your take in the comments. Are you buying the AI plumbing or are you waiting for the prices to cool down?
Thanks for listening.
Catch you next time.